these two are Lamborghinis. This one's a Ford GT and then a Bugatti. And the one I'm wanting to get is this one right here, that Ford GT. That's just something special about that for me.
Every person has his dream car, I don't know, now recently, dream watch, or, the big thing. Okay, so yours is a car and a Ford. I can understand, I live in LA. I actually live in Bel Air nowadays. And yeah, you have expensive cars. I'm still driving my 11 years old Jeep, but that's me. Yeah, no, but yeah, again. Anyway, Gary, thank you very much for joining me here in the InsurTech Talk. How are you doing? How's Kansas City treating you nowadays?
It's doing wonderful. Thank you so much for having me on today, Gillen.
Yeah, my pleasure. And, we're going to talk about one of the not sexiest, very sexy topic in insurance or legal, which is surety bonds. Yeah, I think it's one of those topics that a lot of people are kind of like missing in the insurance market. By the way, is it, before we ask question, is it closer to insurance or is it for loan and stuff like that? How about we start with your origin story, like any other superhero? What do you do? How did you get into what you're doing? And we'll continue from there.
Sounds great. Yeah. So I am actually an attorney by trade, right? So did a lot of work with, large law firms and in-house type of stuff. And then after a while, I decided I wanted to start talking to more people. So I started doing some estate planning type of work. And as part of that, did some probate work. And with probate, you need something called a probate bond or a court bond. And so after I did a bunch of those, I'm like, I thought I'll just do this myself. So we got licensed, got that bond going. And then that just kind of morphed into, okay, now I'm going to do some contract bonds since I already have this bond network set up, with all these carriers, and then into commercial bonds. And so this little side thing I started, 18 years ago has now become a real business that takes up, the bulk of my time.
And okay, no, I'm out of words. That's it. Thank you very much for joining me. It was a pleasure. But so you build a network. You saw the opportunity, but how come it's kind of an overlooked part of the market? Where is it? Was there a plan to enter into to recognize the market, or it was like, I'm doing it. I actually have the network. I should commercialize and monetize my network.
Yeah. So it turned out we just kind of kept expanding as we got more and more people that just wanted us to help them out. Right. So surety bonds is a kind of a subset of the insurance market. And so what it is, it's essentially a guarantee for people to go out and have a third party provide a guarantee. So there are three main types. The first one is the contract bond, which is, if you're building, let's say, for example, you're a contractor and you're building a school, under the Miller Act, it's required for any project over 125,000. Then, you have to get this bond, which guarantees that you're going to finish the contract on time and pay all your material vendors and your subs, right? So because it's required and it's a third party guarantee, or it's a third party contract, so it's not just a guarantee. So we help people walk through that. So that's, we had a lot of clients that said, hey, we really need this, help us out. The one I started with is actually contract bonds, which is court bonds, which is a much smaller piece as compared with contract bonds. There, it's for things like, probate cases, like, so to guarantee that the administrator doesn't take money and leave the estate, or, guardianships, hey, make sure that the guardian doesn't take money for this minor. And then, of course, some of the other ones are, if you lose a case and you want to appeal, you have to put up an appeal bond. Those are really hard to get, by the way. And then finally, commercial bonds, which is, they're small in value, but they're huge in number. There's between 25 and 35,000 of those out there. And that's basically to make sure that you, as a contractor, like a plumber, will pay all your taxes. There's also all these other weird types of bonds out there, like for there's like these cannabis bonds. If you want to set up a cannabis dispensary in most states, you have to have a bond to make sure you pay your taxes. And just all these little weird, to sell fishing and hunting licenses, you have to get a bond. All these little weird little
No
things that are out
kidding.
there.
Okay, yeah, okay, you touched so many different things that I would love to dig into, but we'll try only to touch the main stuff. So you started with, you mentioned guarantee. So I don't know if we're going to cue like, hey, insurance 101, or in this case, it's advanced course in a unseen products that relate to insurance. So why is it not an insurance product? Or, before that, you mentioned guarantee.
Yeah.
What's the difference between surety and guarantee?
That's a fantastic question. So there are difference between a surety bond and a guarantee is that a surety bond is a three-party contract. So that if there's a problem with the contract, you can go directly to the surety. You don't have to, with like a guarantee, you have to go and make sure that they've done and resolved the dispute, then the guarantor pays for it. That doesn't work that way. In surety, you just go directly to the surety and say, hey, there's a default. You make it good. So they can either pay damages or, more commonly, get somebody else to come in and finish the job. And that's why surety is so important, is that these jobs out there, like a road or a school, you can't wait a year delay. That's impossible. So the surety will get somebody out there and get it done on time to reopen that road or get that school ready for the school year. Now,
so who are the three parties that you mentioned?
Okay. The three parties are the surety, the obligor, and the obligee. And the obligor is the person who gets the benefit of the bond. For example, in this case, the school, right? That's the obligee. The obligor is the construction company that's actually doing the work. And the surety is the one that basically guarantees the obligor's work.
Now, my day job, I'm an investment banker, right? So when you say surety bond, I'm like, okay, is that a subset of structured finance that we do? Is it more towards a loan? Because it has the word loan in it. So is it a loan? Is it closer to the insurance space? Where are we in that spectrum?
Yeah, we're kind of all around that spectrum. So not in any specific piece, it's all kind of touches all of that. So let me explain. Surety is different than insurance, although a subset of insurance. Most sureties are large insurance companies. But the difference is insurance is a shared risk pool, right? Where everybody comes together and says, hey, we don't know who's going to have the fire claim, but we're going to share that risk. We don't do that in surety because the premiums would be way too high. So what they do is they write it assuming no risk on that particular deal. Now you say you're an investment banker. So a lot of times where you would see this is that you've provided, let's say, a loan to a developer to build, this massive complex. Well, the builder or the builder goes and they get a general contractor. That general contractor gets a bond for that project because it guarantees they're going to get it done on time. And they're going to pay any material vendors and subs. The reason that you, as let's say an investment banker would do that, is because the real cost to you is not, a little bit of extra cost for that bond, but that delay. Because what you don't want to do is, get a year into your project, suddenly there's a dispute and you have a 2-year legal delay. So if you get a surety bond, well, the surety jumps in and then makes sure that the job is done. And then on the back end, you may have legal stuff, but at least, you've got the project done and it's starting to produce for you.
So we have the surety bonds, we have the guarantee, then we have insurance. So insurance, we have the pool. A guarantee, we had only two parties, and the parties are again the obligator and the obligatee, or someone in between.
Right, it's the obligor and the obligee. Yeah,
obligor and obligee, and that's it. So that's the entire world, and then you have so many niche different surety bonds. Who is doing the underwriting? Is that the surety company? They get capacity from reinsurers?
Yeah, so a surety underwriter, or actually a surety company, is going to be a subset of an insurance company. So it's going to be everybody you've heard of: Travelers, Zurich, Liberty, Sampo, Philadelphia, massive insurance companies. So they have a surety division that is set up specifically for this type of product. And they underwrite based upon, the clients, which is the obligor. And so they're going to take a look at the business, do they have experience? Do they have the financial wherewithal? What is their character, right? They don't want to deal with people because they're providing this backdrop. And they take a look at the owners of the business to make sure that there's not some problem out there. So I always tell people to think of surety bond underwriters as conservative bankers, which is an interesting thing because most people just think of it as a piece of paper, but it's not. It's really somebody providing you with a financial backstop in order for you to get these projects. That's to get the original bond. Of course, then you try to expand that as much as you can so that they can get bigger and better jobs. And as you would expect is that as you grow your bond capacity, there are fewer and fewer competitors because only the really good companies can get these bonds. And so suddenly, the number of companies that can get larger and larger jobs are much and much smaller. So there's typically a lot of demand for these types of companies that would do this and not a lot of supply. So margins could go up a little bit. And that just provides even more financial stability for those companies.
How big is the market?
For, how many hundreds of billions of dollars do they do? Several trillion per year. Now it's
because when we talk about the insurance industry, usually people will throw, it's between 6 to 7 trillion gross written premium worldwide, right? And then you start to divide it in different products, different territories, different products, line of businesses, etc., etc. So you say that it's a trillion, a few hundred billions.
Yeah, it's in for the premium side of it, it's in the hundreds of billions, right? So it's not quite $1 trillion of premium written. That's different than the amount of the jobs, right? Because the amount of the jobs are going to be roughly not quite 100 times that, so about 80 to 100 times that. So that's the size of the actual economy that's being done.
And listen, you started itemizing the different type of bonds that are out there. Any idea what's the total number of bonds or of type of bonds?
Yeah. So it's a great question. And the answer is we don't know. And so we in the industry don't actually know. We estimate there's about 35,000 total. And it's so sad that we have to estimate us that actually do this stuff. Nobody truly knows. We think it's about 35,000, but there are new bonds coming on all the time. So I just did one the other day for a municipality that was brand new. And so, no one had any forms or knew what to do. So we kind of had to make it up on our own. And it's interesting that, even the industry doesn't truly know that number.
No, it completely makes sense. It's, one of the biggest challenges in insurance when you're picking the line of business and then the product, each state you need to work with the Department of Insurance in that specific state, and all the filing and everything need to be publicly available, and there is a lot of transparency, right? So there aren't enough products out there, or the adapting the products is a little bit on the slower side. It sounds to me that who is the governing body or self-regulated agency that dictates the rules for a surety bond?
Yep, absolutely. So all of the surety bond companies are, because they're a arm of insurance companies, are technically regulated by insurance, right? So they file the rate cards with insurance. That's not really who we think about that much. That just says, here's what the premium rate percentage is. The people that really govern this are all of the governmental entities that require those bonds. And so they're going to require their own specific forms, their own specific terms. And so they negotiate with the surety to come up with those terms. Typically, they say, hey, do this. But also the larger ones, they negotiate those. But in general, it's, here are the terms. You surety, please write this, according to our terms. So really, we focus on more what the governmental entities require and less on the insurance regulation. Not that it's not regulated; it's totally regulated, but that's not who we tend to deal with on actual issuance of bonds.
No, okay. So you still need to do the filing part. You have the different entities that monitor, govern you, but you can basically act a little bit faster than an insurance product because of that framework and the different entities and the requirements for what you need to submit, because there isn't a pull, there isn't too much, I would say, because of the one-sided project contract and the legal elements that goes with that. Okay, I would
right.
nod as if I know what I'm talking about.
That's right. You know more now about bonds than 99% of the people in the world. And as I tell people, yeah, you can learn more than just about everybody in 15 minutes, but it takes about a year or two of actually working in the industry to where you get to the point where you feel like you just are starting to know what it is to do.
SwiftBonds. What do you guys do?
Yeah, so we are essentially an insurance brokerage. So what we do is go out, we get the clients, we educate our clients. We spend a lot of time educating our clients so that we can turn around and get the right information from them so we can get them underwritten and get them a bond line. That way that they can then turn around and bid on jobs, right? So they know what their cost would be. And then, once they can get those jobs, we write those final bonds for them, then they can perform according to the terms of that contract.
That's it. Super simple. Thank you. Okay, great. Wonderful. So are you selling other products or only the bonds?
So that's a great question. We continuously look about selling other products, and every time we think we're about to dip our toes in or jump in, we get pulled back just to do more and more bonds. I feel like I keep saying, hey, we need to do A and B and C at the beginning of the year. And then it turns out that we end up spending all of our time, helping out clients, expanding clients, all of that stuff during the year. Then that's where all of our growth seems to go to. Seems to still stay on the surety bonds only side.
So you see yourself as a lawyer, an insurance broker, a surety super master expert, or well, the name is surety Swift Bonds. So how do you market yourself, or how do you present not just the business, but Gary?
Yeah. So what we do, first of all, I think that being a lawyer has helped me out dramatically when it comes to surety bonds because it's so contractual based. And that's how we market to our clients is really based on a couple of things. One, expertise. And then two, we work really, really hard on trying to make the process as easy as possible for our clients, right? So we had develop all of these processes to try to make it so that they don't have to do this back, forth, back, forth, back, forth, but instead try to make it easier on them to gather the information, understand why it's, we're asking for it, to make that process better and easier for them. And so that's kind of how we market ourselves. It's not about, magic this, magic that, but rather here's how it can be easy for you. Here's why it's beneficial for you. And then here's how it can improve your business on a go forward basis. Because we're really focused more in on helping their business to become better and less on simply, get a piece of paper and move on.
So here's what I like about this conversation. Because you're an expert in your field, you already answered a few of my follow-up questions, which makes me go like, oh, do I really need my notes and kind of guiding questions that I had? Because, my follow-up, I try to set the next questions like, okay, let's start talking about marketing, your go-to-market, because it's a kind of a niche product within the bigger insurance element, and you have the brokerage, but then you have about 25,000 different surety bonds. How do you manage, that huge basket of products, and how do you sell it to your them? So all that thing. But you already kind of answered most of those questions, because we're talking about you're a small relatively small brokerage, right? You kind of define it as a two guys and a dog. And sorry if I'm
Yeah.
misdefining it.
Yeah, we're a little bit bigger than that. We're about 9 people, but yes, we consider ourselves to be more a smaller brokerage that stays focused on surety bonds and our clients.
So for the audience, I have I would say, an interesting combination of the audience between the InsurTech, all the cool kids with great ideas and a lot of technology, investors, carriers, and of course, agents and brokers. Now, you're a small brokerage. I would like to say PNC, but no, it's a surety. And you've been working basically by selling it. How do you drive your distribution, or how do you build your pipeline and your customer base? Is it by SEO? You paying Google and Meta a lot of money? Is it word to mouth? What's your marketing plan? Because most of the people trying to figure out their funnel and the conversion right there.
Yep, it's a great question. So we do a couple of different things. So the first thing is the one where we started the business. It's all based on word of mouth, right? Those are by far the best type of recommendations you can get. Those turn into great clients. We love those, and so that's our core, where we get our clients. The second piece is we do some SEO, right? We have partner with some people that are really good at making sure that we can bring clients in through that market. And then number three, we do a little bit of Google ads. We don't do any meta stuff or any other platforms. Again, we try to keep it really sharp and focused. So we're not trying to just hit this broad brush of stuff, but really just kind of on those clients that we think that we can really help. So we have a defined client that we're trying to go after. And once we've defined, now that we've defined them, that's who we go after. But really, word of mouth, and then SEO, and then Google Ads.
So you produce a lot of content with that?
So we have in the past, yes. We have slowed down on the amount of content that we produce, and now on the SEO side of the fence, we're really focused
that's
more
the reason
on
that to have the SEO, so the search engine optimization for all the different things. Because frankly, I haven't paid too much attention until there was kind of people. Basically, search engines are not as it used to be, because everyone kind of typing it in, it's like into their AI engine, ChatGPT or Perplexity or whatever that may be, and want an answer. So this is where it's like, do you still create the same type of content? Is there a need to write that content to still be relevant is it search engine optimization or AI search optimization? Sorry, I cut you there in the middle.
You're exactly right. So it used to be search engine optimization. We really feel like it's going to AI optimization. But where we focus in and where we're good at is really being that expert in the industry, so that people reach out to us to get into personalized advice and counsel. And so that's how we really help people out. And so that's how we write our stuff. We feel like AI is moving towards the way that we've always done it. To reach out and provide a specific, provider like us as the actual expert. So we feel like the industry is coming towards us. Now we have changed how we do things, right? Because we want to make sure that it's, set up properly for AI engines, because we feel like people are moving that way, away from, just search engines. But in general, yeah, that's what we're trying to do, is try to provide really good quality content, right? That provides really good actionable advice, so that they can then come to us and ask those questions.
I'm sorry, you mentioned that, were you a lawyer for 17, maybe 20 years, or SwiftBonds? SwiftBonds is 17 years.
Yeah, so we've been doing SwiftBonds for 18 years. I have been a lawyer for 28 years. So I was a lawyer before, still am a lawyer. I hate to say it, but started off as a lawyer and then set up the bonds on the side.
No, that was my clumsy way of asking how long the business has been around, which is 18 years. And the reason I'm asking, so you have almost 2 decades of experience in terms of how the distribution operation changed over the years, right? So if 20 years, oh my God, 20 years, it's still 2000. Oh, okay. Yeah, no, that's so that's 2006, actually 2008 if it's 18 years. Oh, yeah, no, it's Facebook is already making most of their money from selling ads. And by the way, that's why I ask about Meta, because recently Meta passed Google as the biggest ad network, right? And yeah, no, it's interesting to see, while we have all the different changes and trends in digital, mobile, now AI, how it affected the distribution. Because the reason I'm kind of touching it and over again is that the biggest problem that we've seen in P&C insurance is distribution, especially when it comes to startups that enter the industry, that at the beginning thought that they can go direct, then they realized that they need to work. If they are an MGA, they need to work with the different networks and the different agencies and brokerages. Or if they were already an agency, they need to know even there how to work with other people and increase the relationship. So I just wondered, from your experience in the past 2 decades, how the distribution of surety bonds changed or evolved over time.
Yeah, so the industry's changed quite a bit. Let's talk about on the distribution side. Although we provide bonds directly to clients, it's how we get those clients in that's really changed. Now, the thing that stayed the same is referrals, right? So we love referrals. That has always been the core. We just layer on top those other pieces. We layer on top Google Ads, again, very pointed, and then SEO, now kind of AIO or whatever you want to call it, so that we can get our word out there. We also work with a lot of different other agents that, P&C agents that provide regular type of insurance. Because we do surety bonds only, we don't steal their clients, so they're happy to refer people to us. So we consider those another word of mouth type of referral. We do see it changing a little bit, and so we really see it changing on how you get clients, how do you market clients, how do you work with the different insurance agencies. From a actual processing standpoint, this is where we're starting to see the biggest change. Forever it's been the old two guys in a spreadsheet model. Well, now we're starting to see some different tools that are coming in to make things a little bit more efficient. Surety's still way behind the curve, so don't think that we're going to be there anytime soon. But at least we're starting to implement some things to make it easier to move through those different steps in order to get those bonds to be issued and things to be underwritten.
What's the challenge with underwriting? Why is it so slow?
So many of the people that were originally in Surety learned the old models. And so in Surety, only over the last, I'm going to say 5 years, have we started to get a new set of younger people in the business. Otherwise, it's a bunch of, literally I would be considered young in the surety bond industry. It's old white guys. And that's the way I describe it to everybody. Well, that's starting to change a little bit, but they learned the old school of, hey, I need to go out and actually physically meet the client. I need to do all these different things. I have to have all these different things in the file, and, it has to be written this exact way. That was developed basically back in the 1980s. And so what we're trying to do is move away from that, because the largest claims that we've seen over the last 10 years are clients out there that somebody has actually physically gone and met. They say all the right things, but their financials don't look good. But it's because, there's a personal relationship. Well, that doesn't mean anything. So we're trying to move ways, when we talk to clients, hey, how can you be strong? How can you bid things correctly? How can you, improve your financial profile and your bottom line so that they don't get into trouble in the first place, or we mitigate trouble very quickly. But underwriters are still stuck back in this initial type of underwriting that was developed, 40 years ago, and are just now starting to say, hey, some of those things don't really matter and other things really do matter. And so it's hard to turn this ship around.
Yes, and if you're pale and male doesn't mean that you're stale. And because they used to joke about it, that a little bit, but the more I know the insurance industry, there is a good reason for conservatism and tradition, especially if you look at Lloyd's, but at the same time, you need to look forward, which is a great segue to talk about, okay, great, so that's a problem. Now that we define the problem, let's cue in technology and, okay, add AI as well, because that's the future. So it's slow to adopt. However, reality is upon us. And even if we are looking at, well, we're talking about 20 years almost, mobile, we're talking about 2000 and almost, 17 years, something like that. Everyone, carrying everything in the pocket. And nowadays, well, with the different AI, we are carrying a supercomputer in our pocket and have access to so many different things. How is that going to impact the surety bond world? Underwriting, distribution. I'm sure that internally you're using one or two AI tools just to improve your efficiency or productivity.
Yeah, so we see it kind of in three different ways. Way number one is just, bringing clients on board. How do we use AI to, one, reach out to clients, then two, bring them on board? The second piece is, okay, once we have a client or potential client, how do we use AI to make things more efficient, right? How do we gather all the information that we need to gather? How do we put it into a way that can make it more easily reviewed and then package it up and send it to underwriting? And then, of course, underwriting takes a look at it. And I think that's where AI can be very impactful by taking a lot of what we call today are those manual steps, making it easy to get that information so that the things can be identified so you can focus on the real risk issue, right? Because, our industry is so small, right? You don't have massive numbers of underwriters out there. So you have a lot of experienced ones. You want to make it easier on them so they can identify, here are the things I really need to focus on this type of a job. And we think that AI can be used in order to consolidate those things to, hey, take a look at these few things. I mean, this shouldn't be making decisions all by itself, but it could say, hey, here's the four things to take a look at. The underwriter can take a look at it, skip that 30 minutes of fluff time and really say, hey, this is what matters. And then you still have a lot of human interaction. Additional requests can be made, and AI can be very helpful with that. And so that's how we kind of see it impacting the industry.
That you would like to highlight? Because I realize that we are getting into 35 minutes in.
Yeah. The only thing I would highlight is that, in the surety bond space, a lot of insurance clients may want to take a look at it because, like you said before, it is an additional market where they can provide benefit. So insurance agents can obviously provide benefit to their clients, but really more for clients that are out there, here's another path of ways to go out and, increase their business. It doesn't have to be everything to them, but, bonded work can be significant for them.
If a new startup or entrepreneurial brokerage wants to build, the next billion-dollar company of surety, what should they do? What should they focus on?
Yeah, if you're wanting to start up a brokerage, what I would do is find a specific type of client that you like, that you can underwrite properly, or use AI to provide that risk profile for and go after that. We find that people that try to do it all struggle, and ones that find a specific niche seem to be doing a lot better. And you can do that either by type of product or by location. So there are, you could just say, hey, I'm just going to stay in the southern part of the United States, or California, which sometimes feels like its own country anyway. Or you could just focus in on a specific type of bonds that you like to do, provide really great quality there. We feel like that's a good way to get going.
Okay, so let me ask you the last question, kind of a question that I'm asking everyone. What should people talk about that they're not talking about regards surety bonds? Or what area should be improved?
Okay. So I believe that surety bonds are like every other industry, right? You can use tools to make it more efficient, make it better on customers. That's number one. But then use those tools to improve and expand. So, for example, with AI, I've read about companies laying off of, tons and tons of personnel because AI makes them redundant. I think that's just a terrible way to do business. Instead, you need to use AI to make it more efficient for the people that are there, and then take those people that were there that you could displace and turn them into new pieces of business. Go after something that's related, where you can provide amazing value to your customers. This is the wonderful opportunity that's in front of us today, is expanding additional lines for people that aren't willing to move forward.
And for the audience, and most definitely, and the people who listen it on, I don't know, Spotify, LinkedIn, or YouTube, who should reach out to you?
Yeah, so you can reach out to us at SwiftBonds.com. That's our website. We're also on, Facebook, X, YouTube. We also have a sister company called access-surety.com. You can reach out to them as well.
Who should reach out to you? And what should they ask for? Surety bond? Most of the people who listen to this will be, again, startups, investors, carriers, agents, brokers. So it's more industry facing.
So for the industry facing folks, brokers, agents, all those folks, typically when they have a client that, can expand into bonded work, feel free to reach out to us. We're happy to answer their questions. For investors and other companies, it's really reach out to us so we can say, here's a way to protect you and your investment, and different ways that we can structure it to help them out.
Awesome. Great. Wonderful. Gary, thank you very, very much for joining me today. It was a pleasure talking with you about SwiftBonds.
Pleasure was all on our side. Thank you so much for having us.
My pleasure.